Hi, my name is Gabby Parker, and I am the executive accountant for Genovations Accounting. We're an accounting firm located in Nashville, Tennessee, operating since 2018, serving several small businesses here in the Nashville area. We're going to be talking about some tax topics today, as it is January and it is the season for taxes. So we've been getting a lot of questions from clients about their individual returns, their business, state taxes, things like that. So we're going to address some of those commonly asked questions here in this podcast. Our main audience is small business owners and individuals with complicated returns, and even S-Corp owners and partnerships. I have my associate, Chelsie Kagay, here with me, and we're just going to jump right in.
Awesome. So the first question is, what documents are required for an outsourced firm like yourself to file my taxes?
That's a great question. There are two things that I'll address here, actually. One is the documents required for an outsourced tax firm like myself, but then also the IRS, because we have to abide also by IRS regulations. So for a tax preparer, we need things like W-2s and 1099s that show proof of income. If you own a business, that comes in the form of a profit and loss statement and also a balance sheet. Balance sheet will show us the equity that you have in the business, debt that you have as well, and assets that you own. So those things are required for tax preparers. Anything else, like an itemized deduction, a charitable contribution, things like that, we will ask you, like, is this information accurate to the best of your knowledge and the best of your ability? And if you answer yes, we have to trust you. Like, we can ask for all the documentation. It's not required, but IRS just requires us to have mainly W-2s, 1099s, and profit and loss statements as tax preparers. For the IRS in particular, they can actually go back 3 years on your tax returns if they audit you or if you have any amendments to file. You can go back 3 years. So it's recommended to keep the documents at least 3 years.
Okay.
If you make a major mistake, like you underreport your gross income by like 25%, they can go back 6 years. So you'll want to keep documents at least 6 years if you've got complicated returns and you're kind of nervous about it. But if you're filing yourself, if you're filing a tax return yourself, the IRS just requires you to have supporting documentation. So receipts, check copies, bank statements. I just recommend keeping that shoebox, quote unquote, in your closet of documents that could be asked of you, and just tucking them away in the case that the IRS does ask for them. But as a tax preparer, those are the documents that we would need in order to file your tax return appropriately.
Nice.
Yeah.
How can I avoid payment penalties from the IRS on my April 15th payment?
Yeah, so a lot of people get surprised when they owe in the spring and the IRS automatically gives them a payment penalty. They're like, why do I owe hundreds of dollars of interest and payment penalties on my IRS bill? Well, it's because you didn't file quarterly payments or submit them on time. So there's this safe harbor rule that the IRS has. Safe harbor rule consists of three things. First is you can pay 90% of the tax you owe for the current year. That avoids any payment penalties by the IRS. If you're unable to calculate what you currently owe in this tax year, you can pay 100% of the tax that you owed last year. So that's criteria number two. If you pay, let's say you paid $2,000 last year, you pay $500 every quarter, so totaling $2,000 in this year, you will not have any payment penalties from the IRS, even if you owe $7,000.
Okay.
Just because you paid 100% of last year's taxes. The third way you can meet the safe harbor rule is by owing less than $1,000 in taxes after you subtract withholdings and other tax credits. So if you owe like $500 at the end of your whole return, no payment penalties can be assessed from the IRS. So for me, like, often tax clients have trouble calculating their own tax liability. So I recommend number two, just pay 100% of the tax you paid the previous year. If you end up overpaying, you'll get a refund. If you end up underpaying, you can just pay it in the spring. But that avoids that payment penalty that the IRS can assess.
What are some reasons the IRS denied my initial tax return?
Yeah, so this one is an interesting one for me because the IRS came out with this new thing called an IP PIN. Okay, so there's a few reasons why they could deny it, but this IP PIN has become the most complex for us tax preparers. So a couple years ago, they came out with this as a 6-digit number that's assigned to whoever voluntarily signs up for the program. It's a new thing to make sure that whoever's filing the tax return is actually that person.
Okay.
Because the IRS has seen a heightened amount of Social Security theft and identity theft.
Yeah.
So they have created this PIN, this IP PIN that they assign to you, and it's a different PIN every year.
Oh, wow.
So once you sign up for the program, you have to go online, you have to sign into your IRS account, and you have to get your new PIN and give it to your tax preparer or use it on your return. And that is in addition to your EIN for your business or your Social Security number for yourself.
Okay.
The IRS also, funny enough, gives this out to people anonymously. Like they assign people who they think are at risk for identity theft. You have no idea you've been assigned a PIN, except if you get that one document in the mail that they sent with your 6-digit code. So like last year I had a client, I filed their return and it kept getting denied. Once, twice, 3 times. I could not figure out why. So I called the IRS and they let me know it's because he needed a PIN, an IPIN, IP PIN on his return. He had never received it in the mail. He never got a notification about it. So he had to call into the IRS and get the IP PIN, and then we had to add it to the return, and then it got accepted. But like you just don't know when you get selected for this program, and currently there's no way to opt out. The IRS is trying to figure that out, but there's no way to opt out of this program. So once you're assigned an IP PIN, you have to get your new one every year, even if you chose it or not. Some other common reasons why the IRS might deny your return is if they received a 1099 that doesn't match what you put on your tax return as income received in a contractor form, or if your personal information is incorrect. So your Social Security number has an incorrect number or something like that. Those are the other 2 things that I've seen the most commonly. So just making sure that your personal information is correct and that the income you're filing matches any other documents, 1099, W-2, things like that.
Okay.
Yeah.
There are so many deadlines. So what are they and how do you keep them all straight?
Yeah. There are so many deadlines. Thankfully, I'm a type A personality and I abide by my calendar to a T. Love my calendar, but some people are not that way. So hopefully I can summarize the 4 main deadlines here on this podcast. So March 15th is when partnerships are due. So partnerships returns are due March 15th. At the same time, the business taxes and the franchise and excise taxes are due on March 15th as well.
Okay.
That's something that business owners often miss, is that the state taxes, for Tennessee at least, are due the same day as their federal return for their business. April 15th is the big one that everyone knows. It's when your individual 1040 or your LLCs are due. And at the same time, again, business tax and franchise and excise tax are due if you have a single member LLC. So April 15th is the big one. September 15th and October 15th are the other 2.
Okay.
September 15th is for any partnerships that were extended. So you get exactly 6 months from March 15th to September 15th to file your partnership return. And then if you extend your personal return, you have from April 15th to October 15th. So those 4 dates are the most key to the IRS. And then if any of those dates fall on a holiday or a weekend, it is the following business day. Okay. I think we hit this last year where in 2023, the 2022 taxes were due on April 18th due to the 15th being, I think, Easter or the weekend or something.
Gotcha.
So it's the following business day. One last thing to note on this is if you extend your federal return, if you're a business owner and you extend from April 15th and you go to October 15th, the Tennessee state taxes do not get extended as well. Okay. You still have to file a return within the 10TAP portal, Tennessee Department of Revenue, on April 15th. You have to estimate what you're going to report, and then you have to file the accurate one when you file your IRS return. At that point, if you owe less or more to the state, they credit you or you just submit your last payment at that time. But you have to file an estimated return still on April 15th. Otherwise, you get to October 15th, you file your state taxes, and you have 6 months of payment penalties that you have to pay.
Yeah.
It can rack up pretty quickly. We've been able to get some like reimbursed or refunded by the state, but oftentimes they're like, no, you paid late, so you have to pay these penalties. So that's something to note as well.
Nice. Yeah. Thanks for the clarifications on that. What are some helpful tax deductions that you found business owners are not aware of?
Yeah. So to clarify first, these are related to business owners, not necessarily employees or individuals. So these are specific to business owners. There's one called UBE, unreimbursed business expense. So you're in a rush. You're at a restaurant, you're meeting a client, and you forgot the company card. You have to put it on your personal card. Those things that are normal, necessary, ordinary business expenses, potentially not on a business account, are called UBEs, unreimbursed business expenses. You can report those on your tax return and still get a deduction for those, even if it's not on the business card. So even if you bought a computer and it was beneficial for you to use your personal credit card, you can get that added to your return, and that is used as a deduction. Vehicle depreciation. So many times clients are like, here's my mileage, let's take the deduction for that. 9 times out of 10, mileage is going to be less advantageous than actually taking the whole vehicle on the business as an asset. So for instance, you have a vehicle, you put on your business, you depreciate it $10,000 in the first year. By doing that, you also get to take the fuel, the repairs and maintenance, any expenses associated with the vehicle. And all of those, maybe they total up to $10,500 on the year. Your mileage at 65 cents a mile, you'd have to drive close to 16,500 miles on that same year to get the same deduction. And you have to track them. You have to have documentation of those. So by putting the vehicle on the business, you don't have to worry about it. You just get to drive your car, use it for business, and not have to worry about tracking your mileage. You can put your business or your vehicle on your business if you use it more than 50% for your business. So if you use it 55% of the time for business, you can do that. So that's one thing that I would recommend as well to business owners. If you're pretty close to a tax bracket, so let's say a business owner is reporting $380,000 of income on their tax return, they're in the 32% tax bracket. Moving just down to the $364,000 gross income level, they go into the 24% tax bracket. So that's an 8% difference. And that, $15,000, $16,000 can equate to $5,000 of taxes because you're at the 32% bracket. So if you can spend $15,000, get down to the 24% tax bracket, that saves you $5,000.
Yeah.
So I also recommend, it's not necessarily a deduction, but just watching how close you are to a tax bracket. Let's say you need a new vehicle. Let's say you have a nonprofit you want to support. You want to give them $15,000 in their endowment fund, things like that. That will save you $5,000 of taxes. And I don't know about you, but for me, I'd rather donate to a charity $15,000 than pay the IRS $5,000.
Oh, yeah.
So it's something to look out for because it can change your tax bracket significantly if you're in the right level.
Yeah.
The last thing that I would recommend is income allocations. So they are called guaranteed payments on the tax return, but income allocations are basically a salary for business owners. So even though you're not a W-2 employee, you can make an agreement with the business that you get X amount per month, you get X amount of the percentage of the net profit, however you want to word it. You can make that an income allocation agreement. You get paid that as the owner, and the business gets to write that off as a deduction, as a payroll expense. Now, the advantage to that is you get to reduce your business income, which gets taxed an additional 15% for self-employment tax.
Wow.
And you move it to your own personal return, which has more options for itemized deductions, any other business losses you have, things like that. Also, you only get taxed, at the IRS federal level there, whereas if you had it on the business, you get taxed the self-employment tax of 15%. Plus, that income pushes to you as the only owner of the business, and you have to pay, let's say, 32% on the income again. So you're actually paying 47% taxes on your business income instead of paying yourself and only paying 32% on your personal return.
What are the state taxes that businesses have to file, and when are they due?
Yeah, so Tennessee is really fun. It has one of the most amount of state taxes of all the states in the United States. Like they have so many taxes. So I'll boil it down to these two that are the most important for business owners. First is business tax. It has the lesser amount of all the taxes, so it's easier to handle and swallow. But they impose it based on gross receipts of a business. Okay. So it varies between 0.1 and 0.5% of your gross receipts, which I actually had a client who reported $184,000 a couple weeks ago. I was filing his return, and he only paid $184 of business taxes. So it's very minimal. Yeah. Thankfully, it was 0.1% in that scenario, but it just varies. At minimum, you have to pay $22 for every location that you have in Nashville. So it's $22 at minimum. The state actually sent out a notification recently to all business owners in Nashville, hopefully, that if you do under $100,000 of gross receipts in a year, you are now exempt from this business tax.
Okay.
So you don't have to pay business tax. It's a nice $22 you get to keep, you know. But in finding out what you have to do for this exemption, we actually are going to make another podcast on it because there's a whole step-by-step process you have to go through in order to qualify for the exemption.
Okay.
Yeah, but you don't have to pay that $22 anymore if you make under $100,000. The second tax, and they're kind of lumped together by the state, but it's franchise and excise tax. So franchise tax is based on the net worth calculated by the book value of the company's tangible property assets. So construction companies often have this tax imposed on them because they own several like large vehicles, or they even may own some buildings that they rent out to people. But let's say the book value is $100,000. You'd have to pay taxes on $100,000, even if you only made, let's say, $5,000 that year.
Oh, wow.
It's based on the net book value of whatever you own within your company. The rate is 25 cents per $100 of your net worth. Okay. So it's pretty minimal, but it can rack up if you have larger assets. Yeah. The minimum is $100. So you have to pay $100 no matter what. Okay. If you are a very, very small business, at minimum, you're going to pay $100 for franchise and excise tax, $22 for your business tax, and then $300 for your annual report, and then any other fees you have, like if you have an external tax preparer, things like that. Yeah. So thankfully, it's not too bad for small businesses, but ones that have higher net incomes or higher amounts of assets, it can rack up. The excise tax is assessed based on doing business in Tennessee and calculated on the net earnings of your business. So let's say you made $100,000. You'll pay 6.5% on that $100,000. Wow. So you'll pay $6,500 to the state. Wow. Just by making that money. So that's another reason why I recommend income allocations or other things that you can utilize to reduce your business income and push it to your federal income tax return, because your business income will be taxed both with self-employment on the federal level and this excise tax, 6.5%. That's like so much. Yeah. Yeah.
What is the standard deduction and how does it help me?
Standard deduction is an amount allocated by the IRS that any individual can take no matter how much income they make in the year. It is most commonly used by people who only have W-2 income. Business owners, if they're small business owners, also utilize this. But I have several clients who make enough in their business where they can have itemized deductions because they have funds, they have capital to spend on their personal deductions. So the standard deduction for 2023 is $13,850 for a single filer. If you're married filing jointly, it's just double that, $27,700. Now in 2024, it will increase $750 up to $14,600 per individual filer. So it gets higher as time goes on, and even in 2023, the IRS increased it about $900. It was a pretty big jump. Yeah. But it is advantageous for anybody who, doesn't have enough itemized deductions to make it past that. They automatically get $14,600 back in their pocket. Itemized deductions are comprised mainly of mortgage interest, state and local income taxes, property taxes, medical expenses, and charitable contributions. So those are the most common expenses you can have to accumulate up to more than $27,700 for at least 2023. If you can do that, it's good to itemize. If you cannot, you should take the standard deduction on your personal return.
Okay.
Thanks for joining. We'll see you next time for our other tax topics.